All right, guys, AutoNation, we're going to look at the stock today. If you're new to the channel, I want you to realize that we do a wide range of videos. In our videos, we're going to have things for basic investors, early investors who are just learning, and then we also get more advanced as time goes on in the videos for the more advanced investors. Either one that you're at or somewhere in between, there's something for you in this video. Please watch all the way through. We're going to do news about the company. We're going to do analyst estimates. We're going to do bull and bear cases. We're going to go through our very famous 8-pillar process. And then we'll culminate the whole video with our stock analyzer tool, which will allow us to make assumptions about the future of the stock and tell us what price to pay. AutoNation sells a lot of cars. You know, when I look at Carvana, for example, I'll compare it to AutoNation in some sort of form to see what kind of money could be made in that business. I believe the Gates family owns a lot of AutoNation.
Really?
Very much so. I think you can probably look it up. There's a lot of AutoNation owned by Bill Gates. I believe his family office is like Citadel Investments or something like that. So, or maybe it's something, I don't remember the name. So let's take a look at AutoNation. Let's pull it up in our software. Ticker symbol AN. For AutoNation. All right, in the last 5 years, it's up 200%. Year to date, up 41%. So, market cap of $6.8 billion. Now, guys, $6.8 billion market cap very simply means if you bought all the shares outstanding and you own the entire company at market price today, $6.8 billion. Now, down here, enterprise value of $15.7 billion. That means if you bought the entire company's shares plus all of its debt and cash, it would be $15.7 billion. Car dealerships and car sales companies tend to have a lot of debt because those cars are bought on some sort of fleet plan with a bank. They don't just pay cash for those cars. So I'm okay with this debt level here because there's going to be a lot of cars here. Now, one of the most important aspects of an auto dealership is their gross margin. That 20% I like a lot. I love it. If you look at a company like Carvana's gross margin is 11.8%, so not nearly as good. AutoNation, almost 20%. That means for every car they sell, if they sell a car for $30,000, the gross margin on that's about $6,000. And their bottom line in the last 5 years has been 3.7, in the last year 4.5%. Now, one of the things I want to show you, the auto industry, Mo, has had a very big surge, especially used cars in the last few years.
Big time.
But look at AutoNation's revenue, though. It wasn't as big a jump. We went 18, 20, 21, 21, 21, 21, 20, then 24, 26, 26.
I actually prefer seeing that.
So do I.
Like a Carvana, I think I remember.
Are you in Carvana now?
Yeah. So these were big. I mean, they went from $3 billion to $4 billion to $9 billion to 14.5.
Down to 11.8.
Down to 11.8. But you saw these big jumps that happened. I would rather see that than this.
All right, guys. So AutoNation has 250 dealerships at 350 locations plus 56 collision centers. They'll also have 12 AutoNation USA used car vehicle stores, 4 auction sites. Okay, so that's why their sales are more consistent. Because in the used car area like Carvana, we saw the used car market. It skyrocketed, then collapsed. It's like, not collapsed, but it's gone down, et cetera. So
and even now, you still see, when we look at CPI, you look at the inflation number that's happening with used cars. It's all over the place.
Yeah, it is all over the place.
It's very inconsistent over the last couple of years.
Yeah, correct.
A few years.
All right, so let's take a look at, oh wow, look at this 5-year return on invested capital, Mo.
Damn.
16.6%.
A lot more than I assumed it would be.
So guys, I do wonder how much of the car industry is changing.
As far as sales go?
Yeah. Mo, we've talked about this before. I can't stand, one, negotiating cars, and two, people who brag about negotiating for cars.
Yeah.
I just wish it was like Best Buy. This is the car you want. This is the price you pay.
Or Tesla.
Or Tesla, right. I just much prefer that model. Now, does that mean that's going to drastically affect auto? I mean, I doubt it. I think it's going to be more on the manufacturers themselves to become more efficient and give better pricing and just say, hey, listen, we want you guys. My personal opinion is if manufacturers want the dealerships to focus more on quality of service, it should have one MSRP. This is the price you pay, take it or leave it. Because it allow the dealership then to be all about service. If you know you can buy remember back in the day with Circuit City and Comp USA?
Yeah.
So we had Best Buy, Circuit City, and CompUSA. Which one won?
Best Buy.
Yeah, Best Buy's still around. The other two are gone.
Yeah.
That's the way I look at it. But AutoNation, one of the things we like about them, if you're going to look at their 8 pillars also, look at their shares outstanding, Mo, in the last 5 years.
Oh, holy moly.
They've bought back a lot of their shares.
Wow.
Their 5-year PE, is 7.83. Their 1-year PE is 5.67. So those of you who are new, this buying back of shares is awesome if the stock is cheap. And the 5-year PE and the 1-year PE are telling us the stock is cheap. Buying back cheap shares is a wonderful, wonderful thing. Why? Because now they can take their profit and divide it amongst less and less investors. So as an example, let's say a company has 10 shares outstanding and you own one. You own 10% of the business. But if they're like AutoNation, they bought back 50% of their shares. Now their shares go from 10 to 5. You now own 20% of the business doing nothing but sitting there and waiting. So now you get double the profit per share that you got before. Go ahead, Mo.
These buyback numbers are insane. If you pull up the income statement,
I see that.
What the heck?
So go to Mo's screen here. They had 119 million shares outstanding 10 years ago. Now they have 45 million. So are they just taking all their cash flow and buying back shares?
That's what it seems like. I mean, and I did go over to the cash flow statement to look at acquisitions and dispositions, and there's nothing huge that says, oh, that's why they bought back 20 million shares or got rid of 20 million shares or something like that.
Wow.
Yeah. That's crazy.
So let's look at it this way. Look at 10 years. They made $400 million and now oh my gosh. Crust. That's incredible. Let's look at their cash flow. Their 5-year average free cash flow is on $900 million, but I want everybody to look at this. This is an issue. Mo, look at this. This is before COVID. This is after COVID.
Oh boy.
Oh boy is right. So they go back to pre-COVID levels. They were doing 230, 250, 300. Then they crossed the billion mark. And now
they've dropped below the billion mark.
They've dropped below the billion mark. And it's still 3 times more than previous.
Right. Does that mean that they're going to come back to 300 million?
And if they do, that takes their PE from 7 to 21. And that's probably why they bought back so many shares, Mo.
Yeah.
Right?
Right.
Because they're like, hey, we have all this cash here.
Let's do it.
Let's do this.
This is one of the biggest buybacks I've seen.
In such a rapid period of time.
Yeah. Usually you'll see a couple million shares bought back, not 20 million.
So how many shares outstanding do they have right now?
45 million.
Okay. So guys, let's do the math here real quick. Let's say they make $900 million a year, which is what they made last year, basically. They have 45 million shares. That's $20 per share. If they had the shares from 5 years ago, which was 90 million shares, it would be $10 per share that every share would be getting. That's the growth in EPS by buying back cheap shares. Now, fast forward. Let's say they figure out a way to do $600 million in profit going forward. $600 million. So now they have $600 million, so which is still less than today. But they buy back 15 million more shares. They go to 30 million shares outstanding. Guess what? You're still at $20 per share in earnings per share because they've bought back 15 million shares. So even though their earnings overall as a company are down from 900 million to 600, their earnings per share are still the same level because they bought back those shares. But again, if they're buying back expensive shares, it's not good for the company. It's not good for the investor. And that's what's key. Mo, why don't you go over some news, bull, bear cases, etc.
So something that's been in the news a lot, and this is just not specific to AutoNation, it mentions Carvana in the article, that car prices are seeing falling margins and margin pressure that's going to be coming. And it makes sense for the kind of rapid increase that we've seen over the last few years, I should say. It's probably 4 years at this point. A couple of bull cases. So this is pretty surprising.
Well, can I interrupt you real quick?
Yeah, go for it.
So look at the income statement before COVID. They were at about 15% gross margin. Okay? And now they're at 20%.
Yeah.
So are they going to revert back to the mean of their 15% gross margin?
Yes.
Probably.
Yeah.
I would agree with you there. So guys, keep in mind their gross margin, that's the profit per every unit they sell extra, has increased 33% since before COVID. That's something to consider here when looking at a company. You don't want to just buy based on its best year.
Yeah.
Go ahead, Mo.
This is interesting. I didn't know this. They hold 23.25% of the market share behind CarMax, which is 24.5%. So they're right there.
Wow.
With CarMax. They've acquired 5 dealerships and opened 16 AutoNation branded stores. The auto repair market, so this is big. We talked about service. This is going to grow at expected to grow to 6.1% compounded annual growth rate through 2030.
Okay, that's high. That's probably going to be higher than GDP growth.
Yeah. Oh, yeah, for sure, I think.
Yeah.
So bear cases, as the semiconductor market stabilizes, AutoNation will no longer get the tailwind of high demand for new cars and used vehicles. Net income was down 28% in the most recent quarter. Operating income fell 21%. But again, you're coming off of highs. So when you say it's down and it's falling and stuff, put it in perspective. 35% of vehicle production is related to the semiconductor costs. So that future is unpredictable at this point, don't you think? It's kind of up in the air right now.
Yeah. When it comes to semiconductors, I just personally believe that these are temporary problems.
And it's
right?
going to be bigger in the future.
And if we have some sort of recession at some point, global or US, it's going to tame down the demand, which allows supply to get back into normal. Right? Mm-hmm. All right. Guys, I think with AutoNation, this is I love the fact that when their profit increased, their cash flow increased, they just bought back a ton of shares.
That tells me that management knows what they're doing.
Oh, way smarter about man. And the other thing is, I don't like to clone. What I mean by cloning is I don't like to look at a good investor and say, I'm just going to do what they do. But Bill Gates and Warren Buffett are good friends. And if Bill Gates has a large chunk of money in AutoNation, something tells me he's probably gone to Buffett and said, what do you think? So yeah, verify that.
So I have seen here Bill Gates, I Googled Bill Gates own AutoNation. Bill Gates sold AutoNation stock. That was in 2021, the fourth quarter. He sold $78 million of stock. He also sold off a lot of shares in 2019 out of their trust.
I remember reading an article recently which showed Bill Gates' portfolio. It was like a post where it said his portfolio, and it had a chunk in. Yeah, let's look at this. His portfolio. And guys, the reason we like doing these videos is we don't want to our goal is to sit there and show you guys how we think about a company immediately upon seeing it. Did you not see it there? Mm-mm. Wow.
Yeah, this is his 13F filing. I don't see.
Okay, maybe he's out of it then.
Yeah, I don't see it.
Maybe he's out of it. Boy, he has a lot of stocks.
He does.
Stocks. Oh, he has Carvana?
He has Carvana.
What the what?
And Vroom. Oh, okay.
Oh, I'm kind of surprised by that.
All right. We get it.
So let's take a look again at our 8 pillars here. Now remember, guys, if you have our software, you can customize your 8 pillars right here with up to 12 pillars and like 4 quadrillion different variations. But Mo, this is an 8-pillar stock.
Yes, it is.
This is absolutely an 8-pillar stock, and I love this ROIC, 16.6%. What does this mean, guys?
Very surprising to me.
Yeah, I was surprised too. What this means, guys, is the company gets a good return on the money invested in the business. You want to pay a premium for companies with a high return on invested capital. It means they can take their cash and reinvest it at high rates of return. And this also shows some sort of moat status. Now, I'm not saying AutoNation's a moat itself, but that's a pretty impressive ROIC. And the 1-year ROIC is 21%. Mm-hmm. That's pretty incredible. No dividend, which I love. And the reason I love, and so all those haters out there who are like, I'm a dividend investor, whatever that means. Dividends should only be paid if it's the last resort for a company. If they have no other ways of making acquisitions that make sense, buying back cheap shares, or reinvesting back in themselves. So for those of you out there who want to own a company purely for a dividend, you should only do that if it's the last resort for a good use of the capital. That's it, right? All right. So let's look at analyst estimates. There are not a lot of analysts here looking at this company. Revenue growth, it's actually showing revenue growth, but flat on the profit. So it shows that they're expecting gross margins to decrease. So think about that before you get confused. If earnings are the same, but revenue is going up, it means what we said earlier. The only way that to happen is they either increase expenses or their profit per unit sold goes down. And we already told you that before COVID, their profit per unit was about 15%, and it's jumped up to almost 20. So the analysts are probably factoring in an adjustment in that, a decrease back to normalized levels, right? Mm-hmm. Okay, guys. So the next question is what, Mo?
do we pay for it?
What do we pay for this company? It's currently at $152 a share. And remember, looking at the price of the stock gives you nothing. What you want to remember is when you buy a stock, you're buying a piece of a business. And our goal here, and the reason why the stock analyzer tool has been so popular, used 1.3 million times by our users last year, is because it allows you to take your assumptions about the future and tell you what price to pay based on that. So if you've liked what you've seen so far, you got to realize we have tons more tools than just what you've seen. We have retirement calculator. We got the real estate calculator, which is grandfathered in right now. If you sign up today, you'll get real estate calculator for life. In a few weeks, it's going to its own separate level. We have to buy it separately. So if you get it today, you get it for life. And you get our community, thousands of investors who talk every single day, who are active, talking about their investments and getting a good idea of where they stand. These are like-minded investors who all bring a different avenue of how to think about investments. So again, everythingmoney.com. $7 for 7 days is our promo. You can try it out for $1 a day. This makes complete sense. Try it out now. Sign up. Lock it down. So just for this week, guys, we're running a special $10 off. It's usually $39 a month. It is now $29 a month. It's just here for the last week of July. Go sign up, everythingmoney.com. All right, Mo, so 10-year analysis, you can do 1 to 20. So, Mo, give me some revenue growth numbers.
What do you think about 4, 6, and 8?
Wow, really that much?
Well, the thing that got me on the low end is we always talk about keeping up with inflation. And over 10 years, I do think they can probably do that. Don't you think? I think 8 is a long
I think
shot.
4 is very low. I mean, sorry, very high. That's I'm not.
So
I think 8's high. I think
would you go
8's
like 0, 2, and 4?
Oh, I was going to do 2, 4, and 6, but maybe we do 2, 5, and 8.
8 is very high. Very high.
Well, they did. I think 2, 5, and 8 then, and here's why.
Okay.
We don't know what kind of consolidation is going to happen in the car business. There's a lot of things that
true.
have to happen, but I think 5%, like you said, they did 4.5% to 5% to 6% in the last 5 to 10 years. So I don't think 5% is unreasonable. 8 is very
unreasonable.
8's high.
It's high,
but
it's achievable, but high.
and we love to show a really high number. That way, if it comes with our high price, is still lower than the current selling price. It just shows how ridiculous the price really is.
Right.
All right, what about profit margin?
I was thinking 2.5, 3.5, and 4.5.
I love it. And the reason, guys, look at this. Even though their profit margin in the last 3 and 5 years has been higher, in the last 10 years it's been much lower. And again, it's consistent with that decrease in the gross margin. What about free cash flow?
I was thinking about putting the same thing.
Let's do it. Okay, PE. Now this PE, guys, don't look at this recent PE
Right.
and consider, don't do that. Don't do that. Put a reasonable PE in. They have a high return on invested capital. They don't have a great growth rate, but when it comes to PE, we always start at the market average of 15 and go up and down from there. We go up if it's high return on invested capital along with a high growth rate, and we go down for the exact opposite. Moats, things like that. This is part of the art of investing, right? So Mo.
I was thinking 12, 14, and 16.
Okay, well, it's not far off from what I was thinking.
What are you thinking?
I was thinking 13, 15, 17, but I like 12, 14, 16. Because I think there's more headwinds for the car business than we probably want to acknowledge.
Right. And a lot of just unknown in general. What if they all do go to that certain sales model?
Correct. All right, now, our final metric. What is your desired annual return? This is where you put your margin of safety in. The higher your assumptions, the greater your return needs to be for yourself. And that's your higher margin of safety. The more return you want, the less price to pay. This cell phone, it's $1,000. Your return is higher if you pay $100 for it than if you pay $900 for it, right? So the higher the return, the lower the price. All right, Mo. Oh, wow. Why did all of a sudden, oh, wow, they're down 2.5% to 2.25%. So give me your annual returns.
So I was thinking 11, 13, and 17.
Wow. Because of how high the...
yeah.
So we usually don't do that, guys.
No,
We
I
usually try to
don't
keep
do
it
that.
pretty evenly spaced. But Mo was saying, listen, this is pretty high here. We made some high assumptions here. I want a really high margin of safety. I don't blame him. I think he did the right thing. So guys, we're going to hit the analyze button. There's going to be some data coming out here. Listen through the entire video. I want to make sure that you understand our explanations of the numbers and what they mean. It's super important. If you're just here to get a price and move on, probably not the channel for you. We're trying to teach you how to fish here. We're trying to teach you how to apply this level of thinking to other things you do in your life. We want to give you the confidence because guess what? if you understand these ideas that we're talking about, if AutoNation stock falls to 50, you'll understand why that might be a good deal or a better deal. So hit the analyze button. Stick with me through the entire video. Whoa! I was
right.
not expecting that.
Neither was I. Neither was I.
Holy cow. I was not expecting that. Wowzer. Low price of 165, a high price of 350, a middle price of 270. Now here are these numbers below. If you pay today's price and the lowest assumptions occur, you're going to make 12.34%. If the middle assumptions occur, you're going to make 22%. If the highest assumptions occur, you're going to make 33%. So what are we missing here, Mo?
So the question is the cash flow and the margins. Those are two big things that we need to figure out what's going to happen.
Yeah, but look, we put in the lowest of margins here.
I know.
We put a lower margin in their last 10 years.
And a lower cash flow, free cash flow margin.
Wow. And look at the PE we put. Now, granted, the PE is helped by the fact that the current PE is very low, but still. Wowzer. Now, guys, we're not telling you to buy this stock that's all green. It's really important that you go do your own research and understand why you're buying the company. Because if the price falls, you need to be able to be okay with that. But this is surprising. And I don't even have it on my watch list.
So I shrunk my profit margins to 1.5% for profit margin, free cash flow margin, raised the PE to 15, and I got 110.
Wow.
So I'm just playing and seeing what it would take to get down to
incredible.
That price.
Well,
Yeah.
I think I need to start doing some more research on AutoNation. I'm going to tell you that right now.
Yep.
So guys, if you like any of these prices, you can add it to your watch list by hitting the plus mark. Again, guys, $10 off through the end of the month. Sign up today, everythingmoney.com. We appreciate your time.